Welcome back to the channel. I'm Algabot, and today we're studying an expert advisor for MetaTrader 5 called the Ulcer Index Trend Pullback. This is a trend continuation approach, sometimes described as buying the dip inside an uptrend or selling the bounce inside a downtrend. What makes it interesting is the quality filter at its heart, Peter Martin's Ulcer Index, a measure of how smooth or how jagged a trend has been. By the end of this video, you'll understand how that filter works, how the entries and exits are built, and how it all comes together on a chart. Remember, this is educational content only, not financial advice. Let's start with the big picture. The Ulcer Index Trend Pullback is a system that waits for an established trend, then tries to join it on a shallow pullback rather than chasing price at an extreme. That idea is common, but the twist here is the filter used to decide whether a trend is even worth trading. Most trend filters only ask two things: is price above its moving average, and is that average rising? They say nothing about how price got there. A market can climb 2% by gliding smoothly, or it can climb the same 2% through a violent sawtooth that shakes out every pullback trader along the way. The Ulcer Index measures exactly that texture. It is the root mean square of the percentage drawdowns from the running peak over a window of bars. A low reading means a calm, orderly advance where retracements are shallow and brief. A high reading means a jagged, painful trend that whipsaws. The strategy only takes a pullback entry when the trend has been smooth, because pullbacks tend to continue more reliably inside an orderly trend than inside a choppy one. Direction is defined by a baseline simple moving average and its slope. The timing of the dip is handled by a faster exponential moving average that price pulls back to and then resumes from. Risk is measured with the average true range, so the stop distance and the take profit both scale to current volatility. Because the Ulcer Index is expressed as a percentage and the stop and target scale with volatility, the same default settings tend to travel reasonably well across different symbols. This kind of approach is generally studied by swing-oriented traders looking at trending currency majors or indices on the 1-hour to 4-hour time frames. As always, trading involves risk, and losses are a normal part of any strategy. Now let's walk through the mechanics. The expert advisor works on closed bars only, acting once per newly completed bar so it never reacts to a flickering, unfinished candle. It also holds just one position at a time for its magic number, letting the stop and target manage the exit before it looks for another trade. It skips new entries when the spread is wider than the allowed maximum to avoid poor fills. Consider the long side first. Three things must line up for direction and quality. First, the just closed bar must be above the baseline simple moving average, and that average must be rising when compared with its value a few bars earlier. This confirms an uptrend that is actually advancing. Second, the downside Ulcer Index, the drawdown texture of the recent move, must be below the smoothness threshold. This is the quality gate that filters out jagged, whipsawing rallies. Third comes the timing. The strategy waits for a dip to the fast exponential moving average and a resumption. Specifically, the prior closed bar must have pulled back to or below the fast EMA, and the current closed bar must close back above it. That combination says price dipped into the mean and is now turning up to rejoin the trend. When all of that is true, the EA signals a buy. The stop loss is placed the ATR stop distance below the entry, and the take profit is set at the reward to risk multiple of that same stop distance, which by default is 1.8 times the risk. The short side is a precise mirror. The just closed bar must be below a falling baseline average. The upside Ulcer Index, the draw-up texture, must be below the threshold, and price must rally up to the fast EMA and then roll back beneath it. The prior bar closes at or above the EMA. The current bar closes below it, and the EA signals a sell. The stop sits the ATR distance above entry, and the target is the same reward to risk multiple below. Everything self-scales with volatility, so the logic behaves consistently as conditions change. Here is the core of the MetaTrader 5 code, the way you'd see it in MetaEditor. At the top are the inputs. The Ulcer period sets the window for the smoothness measurement. The trend period is the baseline moving average, defaulting to 50, and the slope lookback decides how far back we measure its slope. The pullback period is the fast EMA that price dips to. The Ulcer threshold, defaulting to 1.5, is the maximum Ulcer reading allowed for a trend to count as smooth. The ATR period, ATR stop multiple, and reward risk shape the exits, and there are inputs for spread, lot size, and the magic number. Now the long block. The variable long setup is true only when the closed bar is above the baseline average. The trend is up, the downside Ulcer reading is below the threshold, and the prior bar sat at or below the fast EMA, while the current bar closed above it. When that holds, the code reads the ask price as the entry, places the stop loss the stop distance below it, sets the take profit at the reward risk multiple of that distance above it, and calls trade.buy with those levels. The short block is the mirror image. The short setup variable requires the closed bar below a falling average, the upside Ulcer reading below the threshold, and price rallying to the EMA before closing back below it. Then the code takes the bid as entry, puts the stop the same distance above, sets the target below, and calls trade.sell. Same structure, opposite direction. Let's bring it all to life on this illustration. On the price panel, you can see two lines drawn over the candles. The gray line is the baseline 50-period simple moving average that defines the trend, and the blue line is the fast 10-period exponential moving average that price pulls back to. Below the candles is the Ulcer Index panel, with its smoothness threshold drawn at 1.5. When the Ulcer Index sits in the green zone below that line, the trend is smooth and orderly. When it climbs into the red zone above the line, the trend has turned jagged and whipsawy, and the strategy stands aside. Watch the opening candles. Price is stepping higher, staying above the rising gray average, and down in the subpanel the Ulcer Index hugs the low, green part of its range. That tells us this advance has been calm, with only shallow dips, exactly the kind of trend this system wants to join. Now look at the fourth candle in our sequence. Just before it, price eased back and the prior bar dipped down to the blue fast EMA, giving us the pullback the strategy is patient for. Then this bar closes firmly back above that fast EMA. While the trend is up, price is above the baseline average, and the Ulcer Index is still comfortably below the smoothness threshold. Every condition agrees, so the EA signals along, and you can see the buy entry marker printed right there. From that entry, the stop loss would sit in ATR-based distance below, tucked under the recent dip, while the take profit is set at 1.8 times that risk above. Follow the next two candles as price resumes its climb, pushing to a fresh high and reaching the take profit target, shown by the first take profit marker. That is the long trade completing, the pullback continuing in the direction of the smooth trend. Now the character of the market changes. Price stalls at the top and rolls over, and notice the Ulcer Index jumping up into the red zone as the move turns choppy. During those jagged bars, the strategy refuses to act because the smoothness gate is not satisfied. Price then works lower, breaking below the gray baseline average, which now begins to fall, defining a fresh downtrend. As the decline settles into an orderly slide, the Ulcer Index drops back down into the green zone, confirming a smooth move once more. Watch the 10th and 11th candles now. Price rallies back up to the blue fast EMA. The counter trend bounce the short side waits for. The prior bar tags that EMA from below, and then the next bar closes back beneath it, while price is under a falling baseline average and the Ulcer Index remains below the threshold. The mirror conditions all line up, so the EA signals a short, marked by the sell entry. From there, the stop loss would rest an ATR distance above, over the little bounce high, with the take profit the reward risk multiple below. The final candles carry price down to a fresh low, reaching that second take profit marker. Both trades illustrate the same core idea: join a smooth, orderly trend on a pullback to the fast average, and let a volatility-based stop and a reward-to-risk target define the exit. So that's the Ulcer Index Trend Pullback. We covered how the Ulcer Index screens a trend for smoothness, how the baseline average sets direction, how the fast EMA times a pullback, and how the average true range shapes both the stop and the reward-to-risk target on the long side and the mirror image short side. The real lesson here is trade quality, waiting for orderly trends rather than jagged ones. Remember that this has been educational information only, not financial advice, a recommendation, or a solicitation, and every strategy experiences losing trades. If you found this breakdown helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling me which strategy you'd like me to study next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.